Hey everybody, welcome back to Value Stack Podcast. Today I'm joined by Zechariah Schaefer. A friend of mine here, met a couple years ago online through mutual interest on LinkedIn. Wound up moving to Denver. Now we're buddies IRL. As a former financial advisor myself, I'm really excited to hear what Zechariah's got to say here. It doesn't go by Zach, by the way. I might make that mistake a few times, but welcome to the show, man.
Yeah, thanks for the invite. I'm happy to be here. And it's funny how I remember our call a couple of years ago. Didn't expect that we'd end up meeting in person because at that time I don't think I was planning on the move out here. So it's crazy how life throws you curveballs. Yeah,
man. Now we're recording a podcast together, much less just being in person and knowing each other. So
yeah.
Today's kind of theme, just being that, I'm a former financial advisor and I wear that badge of former proudly. And being that you are a practicing independent RIA, we'll be talking about Bitcoin and how it fits in kind of like the modern portfolio today. And, I think one of the things that you might be able to really add value to, and for some listeners, is helping people understand where a financial advisor can still make sense and still earn their keep. Because a lot of people today, especially people who listen to just Bitcoin, they're like, I don't need a financial advisor. So maybe let's start with there. Why should someone today still consider a financial advisor?
Yeah. I mean, first of all, I can understand why you proudly wear the former label, just because unfortunately in today's investment world and today's advising world, it's really hard to find advisors who are truly valuable. And when you find one, their value, it's their weight in gold. Like they're really valuable, but it's hard to find those. And when it comes to crypto, all of this, I think that I understand why a lot of Bitcoiners, why a lot of crypto people, crypto enthusiasts do not think that they need a financial advisor. And honestly, many of them are right. Everyone needs a financial plan, but not everyone needs an ongoing relationship with an advisor. And if you are really financially savvy, then you're probably good. Now, that said, maybe you want to have some help every so often, but to have an ongoing relationship, not everyone needs that. The way that I look at it is there's kind of like a three-pronged test, if you will, in my opinion, for if someone needs ongoing help. And what I like to tell people is to have them ask themselves, do you have the time? Do you have the talent? And do you have the desire to do it yourself? And if you do, without sacrificing on the quality of the financial decisions you're making, then you should save the money. But the thing is, if one of those things is not there, then at best, you're spending your time doing something you don't want to do. And at worst, you might make a decision that jeopardizes your financial future. So for a lot of Bitcoiners who are really more, awake in terms of money, hiring an advisor to build them a 60-40 portfolio is not the right decision.
Right.
Now, for some of them who may not be as deeply, interested in tax laws as someone like me, having an advisor to help them with the tax strategy, with passing their estate to their heirs once you get above that estate tax exemption minimum, that's something where it could start to make sense.
Right. And every Bitcoiner thinks they're going to be rich. So they're all going to have to worry about estate tax one way or the other. I think that's a good point. I mean, part of why I left is I agreed with that. It was like I didn't see a place where I could really make a difference as much because I'm not that well versed in tax law and like business, like entity strategy and like the things that actually make the difference, right? I mean, sure, dude, I understand like the risk adjusted return and cash flows and portfolio allocation and diversification, sure. Like that stuff's, any kid with a series, you can literally read a book for a few hours and pass the series 7. If maybe it's a little harder than that, but
a little harder, but
not
a ton harder. Yeah, no. The barrier is a little too low, in my opinion, to be an advisor.
Right. Well, so I guess it sounds like that's maybe something. So you don't necessarily focus on that. Then the 60-40, just do you think that the role of an advisor today should be far beyond just that asset allocation person that you talk to? And like what really about the profession stood out to you? Like, why did you decide to create your own firm and be an advisor?
I absolutely do think that the role today of a true financial planner does extend far beyond investment management. I just like to view it as a wheel, and investment management is just one of the spokes. And you have to have it. It's really important. But the thing is, if you're, the engine on your car is the best engine ever, and you don't have good brakes and your steering column's crap, you're not going to get very far, or you're going to crash. And in the same way, nowadays the investments almost manage themselves for most Americans. Once you get into that high net worth category, once you introduce the prospect of private investments, private equity, other things, that starts to not be as true. But for most investors who have anywhere from a couple thousand to a couple 100,000, having a robo-advisor build your investment allocation for you is usually right if all you're looking for is an investment manager.
Because the cost savings is really where it's going to move the needle the biggest. You just need accumulation at that point. Right?
Because the thing is, if you're hiring an advisor to beat the market because you think that an advisor is going to help you beat the market, and
you're getting scammed.
You're getting scammed. Number one, you're getting scammed. Number two, they're investing you in the market. So to hire an advisor to beat the market and have them just put you in the market overall, it's delusional.
How could they beat it if their returns are derived from it?
Exactly. That's my whole point.
That's what I've heard is like, it used to be like because you see like the broker, Wolf of Wall Street type stuff where it's like the financial advisors, the brokers of yesteryear were all about performance and exactly what you're saying, like beat the market. I got this hot stock that nobody knows about and we're going to, but it's not, I mean, even when I left the industry a few years ago, it was moving much more from a brokerage, like transactional commission-based arrangement to one of a more fiduciary model of a fee-based annual assessment. And I found that was good, but I also found that some people would use that as a crutch. It's like, well, I don't have to do a freaking thing, and I get paid. Where at least like when you were churning commissions, you had to do something. Now, granted, that something was not usually in the best interest of clients, and so that's why the fiduciary model did succeed. But I'm curious your takes there, because when we first met, you had just started, like before we actually met in person, because I found you on LinkedIn. And I was just so impressed that you were starting your own RIA in your early mid-20s. And I was like, dude, first of all, I didn't have the discipline to do that, but I didn't have the confidence in like what I knew either. So, why did you start your own firm as opposed to just joining like one of the, big, like even like the big independent RAs, like an LPL or something? Like why did you go your own path? And do you think, looking back, that's still the right decision?
I absolutely do think that it was the right decision. I don't regret it at all. It definitely was the harder decision.
Right. That's why I asked if it was the right path.
It's definitely paid off. And I'm really thankful for not just the fact that it's paid off, but also the time freedom that I have today and the freedom over my business. But that said, the reason that I started, so to give it a little backstory, when I was really young, my parents got divorced. Before that point, my dad worked on Wall Street. He did really well with our money. He's an insanely smart guy. And he also managed the family's money. So up until that point, up until about age 7 or 8, I lived the affluent lifestyle. I remember I was like 5 years old and getting lessons from a golf pro, which is, really crazy to think about now.
Yeah, that is kind of crazy.
And then, a year later, I'm like 6.5, 7 years old. And I'm like, Dad, are we millionaires? And he's like, yes, buddy, we've been blessed. And then a year and a half later, parents are divorced, life's upside down. My mom's trying to manage her money for the first time ever. And I'm like, Mom, why are you crying? Because we had just, left a group. And she was like, well, one of the ladies at my group gave me $50 and we have money for groceries next week now. We've been blessed. And so like the dichotomy of seeing the power of making a lot of money and managing it really well and what that can do for you. Obviously, there were some other things going on there that were not in alignment. And then seeing my mom need advice and not be able to get it and manage her own money really more or less for the first time, aside from a few years out of college. I remember going to the bank and knowing that, the one lady there we trusted, she was safe. And so I think from a very young age, the need for good advice was really implanted in my brain. And the fact that there were people out there who needed it, who couldn't get it, was also a concept that I saw early on. So, going fast forward, got super into tech, super into crypto, all that stuff, still am. And then I took a personal finance class right before I was about to go to college for information security. And the light bulb went off and I switched to finance. Fast forward more, working at a couple really high quality wealth management firms, and they're doing all the things right. They have amazing relationships with clients. They provide significant tax alpha. They do great there. Their investments are good. And you have people who are young, like us. They call in. They say, I'm making really good money. I have some crypto. I have a great job, some student loans. They practically are begging for help. And the advisor says, we'd love to help you, but unfortunately our minimum is $5 million to manage or $1 million to manage.
Or we can't look at your crypto.
Exactly. And I looked at that situation. And I thought to myself, I've always wanted to start my own firm. I've always wanted to start my own business, whatever that would be, whether it was going to be, a pen testing cybersecurity firm or now wealth management. And I looked at it and said, most of these advisors who start their own wealth management firms, that's the traditional firm that serves, pre-retirees and retirees with $1 million and more.
Right.
You have to have some gray hairs for that. But the thing is, there's this huge gap of people, this huge group of Gen Z and millennials who are higher earners.
Henrys.
Exactly. Yeah. Who are, crypto investors who can pay for advice, but the traditional model of charging 1% a year on the investments you manage does not work for them. And so I looked at that and said, I'm better equipped to serve them than the advisor who's older than their parents. Mm-hmm. I enjoy serving them. I've already been working with all of my friends for free for the last few years, just because I'm passionate about this. Let's full send it. So that's kind of the story of how we got to where we are now.
The Colorado way, man. Full send.
Exactly. Bro. Eyes closed, full send, except my eyes were open. But
well, you guys can't see under the table, but it looks like you full sent it. I hope your leg is recovering soon.
Yeah, I'm currently recovering from ACL and meniscus surgery. So full sent it a little too hard playing soccer.
Yeah, you could. Yeah. I'm sure your clients are like, wait, what are you teaching me about risk tolerance again? What sort of things? And what sort of things do you help your clients with that if it's not just the asset allocation stuff? And where do you really carve out your value?
Yeah, I think when I meet people who have met with a lot of and interacted with a lot of traditional financial advisors, or I meet traditional financial advisors, they look at me and they're like, so hold up a second. You're not focused on the investments and you only work with people who are not rich yet, at least in the form of they don't have a lot of money for you to manage yet. It's like, what do you do? And it kind of opens up the their idea of what financial advising can be, because what we really do is we are basically their personal CFO. So really specializing, we only work with crypto investors, business owners, and tech professionals. And ideally, actually, they're all three of those categories, because that's when we really hit out of the park.
Is there a lot of crossover in that? Okay.
Yeah. So what I'm finding is that the clients who I enjoy most working with and the clients who are most attracted to working with me are, say, the tech founder who has a significant amount of crypto. And it's perfect because my model works well with them. And that's exactly what we're focused on. And I'm from that world, so I can relate to it all. But what we actually do for them is basically everything for their personal finances, with the exception of we make recommendations on insurance, but we don't sell it. And we help them create an estate plan. We don't give legal advice. So we manage their investments up to a certain point, included in their annual fee. We do their taxes for them. We do their tax strategy. We give them their financial plan, their advice on risk management. And then we, carry the ball with us and take care of almost everything, so that all I have to do is look it over and sign the dotted line. For example, when it comes to insurance, because we'll make an objective recommendation, but in order to be objective, we don't sell it. We have partners who will make everything so easy for them because their time is valuable. And all I have to do is check it off, look at it and say, okay.
Then do you see the industry going more towards this? And what are some of the challenges growing a book of business with this type of fee structure and supporting yourself?
So I do see the industry going this way, but I see it moving this way very slowly. And the reason for that is that, like you mentioned, there's this old guard, if you will, of advisors who meet with their clients once a year. They spend maybe an hour or two rebalancing their portfolio.
Right.
That client has $1 million, $500,000, $2 million with them. So they pay them anywhere from $5,000 to $20,000 a year based on a standard fee. And they're like, what you're doing is stupid. You are doing way too much work for the clients. You're providing way too much value and you're charging way too little. And while they're not entirely wrong in the sense of we're doing more work and providing significant value, the industry is moving this way. And the clients that are still paying those types of fees and are okay with that type of service are only okay with that because they don't realize what's out there.
Right. So it's like a it's like the days are numbered, because once you find out about that choice,
right,
you don't.
Exactly.
That's the only reason you continue to make that choice is just ignorance of alternatives.
Right. Because you don't realize. Let's say that you are a 75-year-old couple, and you're paying your advisor 1% a year to manage your $2 million. They're bringing a lot of value to you. You don't want to manage your own investments. You don't want to do all your own withdrawals in a tax advantage way to give yourself the retirement income that you need. But the thing is, paying that advisor $20,000 a year,
it's a rip.
It's a ripoff. Now, for the record, I'm not against high fees. I charge premium fees because I bring massive value to my clients. But the thing is, that advisor that's meeting with them once a year, that's doing minimal work, charging $20,000, providing maybe $5,000 of value.
Right.
That's the problem with that situation.
And you're being transparent about what you're charging for. Right. And it's like, I mean, even ETFs these days, like they literally have like actively managed or the what do you call them, the like the sentiment based ETFs that like quarterly rebalance. So like they have this auto rebalancing ETFs.
Yep.
So I mean, that to me, like where even someone like who doesn't really hold stocks and stuff, like I mean, for a Bitcoiner, like there's still like some need. I mean, like I wish I had someone that I could just like bounce off like ideas about cash flow and like thinking about like business expenses. And it's like, I mean, just because you're in the crypto world doesn't mean that, you're completely disconnected. And for most people, there's 1 foot in, kind of 1 foot out. And I envision it being that way for quite some time.
Yeah.
I mean, like, I guess, like, given that all of the complexities exist today, I mean, you've got like the tools that make things way easier, and you've got the ETFs and stuff that basically manage themselves. So you've got like tools that make it easier, but you've also got, the more complicated tax code than ever.
Mm-hmm.
You've got more assets to understand than ever. Like even just like including like Bitcoin and crypto into your knowledge base as a financial advisor is like, that's a big ask, right? And then like, I advocate for Bitcoin, but if you're going to start learning about others, then like that, each one is its own, it's like its own asset class basically, because there's not much in common with them. So, I mean, like how, like in what ways, like given that it's both simpler and harder, like what ways do you think you can really stand out and like make like a value today? And how do you really, like, do you have any anecdotes of like examples where clients have been like, wow, this like really helped me kind of get clear? Like how can you make things easier?
So the way that I like to describe it is that the value that we bring, there is quantitative value, usually in the form of tax strategy or in the form of optimizing their investments, not choosing different investments, but simply optimizing their portfolio for the risk they should be taking.
What does that even? Can like take like what does that even mean?
So when I say optimizing their investments, what I mean is helping them to take the appropriate amount of risk for their situation, whether that's more or less. And I mean, that's basically what it is. Because the thing is, if you're taking too much risk, odds are you're going to end up with no money in 10, 20, maybe less years. And if you're taking too little risk, odds are you're going to end up with almost no money in 10 or 20 years.
Right.
So you have to find, the Goldilocks scenario for them. And then on the side of tax strategy, with our business owners, primarily, that's our biggest value add. So helping them identify the right type of business entity, helping them to properly execute a conversion to an S Corp, if that's right for them, helping them to implement solo 401ks and things like that. So, for example, business owners that we just started working with last year, their tax bill was about $120,000. And if everything goes to plan and they execute everything that I'm helping them to execute, part of the challenge on my side is that sometimes there are things that only they can do, so I can't do it for them.
Mm-hmm.
But we expect that their tax savings alone is going to be $30,000 to $40,000. So when I sit down and tell them that our fee is, $8,000 a year, whatever it is, it's a no-brainer.
Yeah, right.
The fact that we're implementing all this stuff, even if they only work with us for 1 year, which usually very rarely does that happen because we find value on an ongoing basis. But even if they only work for us for 1 year, the ROI is almost 5 times. And it's more than 5 times actually. Yeah. $8,000, 40,000. So,
and do your clients come to you? Like, what do they say about having a small firm? Like, do they ever express like skepticism? And do you share stories like that with them? Because like that sounds like stuff that your guys at the big bracket firms probably aren't helping you with. Like, you're just kind of like getting a gloss over talk once a year, and you're not having enough deep conversations to even uncover opportunity strategies like that. Probably
exactly. And I think, I haven't had a client yet be skeptical of me being a small firm. And the reason for that is they know what they're getting. Because before we charge them $1 in fees, before we manage a penny of their hard-earned money, we sit down through a couple meeting onboarding process and show them exactly what we're going to do. We show them the expected, quantitative value, like I was just saying, that tax alpha or other things. And then also the expected qualitative value of, hey, your time's worth $500 an hour. Right now, you say you spend anywhere from 5 to 10 hours a month managing your personal finances. By offloading it to us, that goes down to 1 or 2 hours a month. Mm-hmm. That's several $1,000s each month that you can now spend growing your business with your family, things like that.
Is that the messaging that you use for marketing, like for advertising your business?
It's the messaging that I use in one-on-one client conversations. In marketing, it's a little more broad just because everyone's situation is different. There's no one size fits all.
I guess like just because when you were saying that, I go to think like, Bitcoiners like probably understand time value of money more than anyone else. Mm-hmm. And sort of proof of work, work in what you're good at because you get a higher return on your time where your expertise is. So I think like maybe that messaging like resonates well with people who are like, hey, like spend your time where you're most effective, mm-hmm. and like let us spend our time where we're most effective, and everybody wins, right?
Right. And I mean, that is what we talk about because I know that the people that I'm working with are really, really smart, sometimes almost intimidatingly smart. But when it comes to finance, when it comes to tax strategy, either they don't know enough and they don't want to know enough, or they could know enough. They just don't want to spend their time doing that. They would rather grow their business. They would rather have us spend all our time figuring out how to save them 50 cents, taxes, as opposed to them doing that because they're spending their time figuring out how to make another dollar, and we're spending our time helping to optimize that dollar tax strategy wise.
What your clients are mostly people like kind of our generation, maybe a little older, just because they've been working longer, but generally like millennials, Gen X, like.
Yeah, so the breakdown,
not the retirees that most are going after.
No,
smart.
The breakdown is 93% of our clients are Gen Z and millennial. Average age
Gen Z has money.
Some of them, yeah.
Okay,
yeah. And the other thing is that we work with clients and help them manage that potential. So working with a 22-year-old who has a whole bunch of crypto that we can't manage, who has a high income, any advisor would look at that and say, that's going to be my worst client, most complex client.
Right. But
I look at that and I say, well, that doesn't matter.
This is my perfect client.
Exactly.
Niche.
Exactly.
Yeah.
But 93% are Gen Z or millennial. About 65% run their own business and 60% are in tech. And then, and this is all absolute out of 100. So there's some overlap there, obviously. And then 40% are heavily into crypto.
What are the most common, like for those types of people? Because I imagine that's like similar cohort to who listens to the show. Like what are some of the common trouble, problems, ways that you can improve those situations that people run into? So
quantitatively, because I always like to say that we bring them in quantitatively with things like tax strategy, with saving them, cold hard cash, $40,000 a year, something like that. Qualitatively, really though, the biggest value we add is helping them to have a plan and stick to it, which is so
the behavioral coaching.
Exactly.
Aspect,
behavioral, course correction, things like that. And that's so intangible,
right?
That we focus on that tax strategy, the other things, the hard numbers. But the biggest value is simply helping them have a plan. Because, I was working with a sales professional recently, and I was explaining to him our value, and he just looked at me and was like, so it's basically, I'm living my personal finance life as if I was a sales professional who had no quota. I don't know what I'm doing. I don't know if I'm going to hit it. I don't know if I'm not going to. So helping them to have a plan and know what they're shooting for is so valuable. It's like that quote from that one movie. It's kind of cheesy, but it's, if you don't know what you're shooting at, you will hit nothing. There's no doubt about it. So qualitatively that. On the quantitative side, the biggest thing is the tax strategy. And a lot of them just don't know the tax breaks, the tax opportunities that are available to them. So they don't know what they're missing out on. Or they make a big mistake and then hire me. Unfortunately, I mentioned how 40% are crypto investors. Every single one of those actually made a big tax mistake. And that was the catalyst for them hiring me, sadly.
People always take action after they feel pain, not before. So I've never seen anyone take self-custody of their crypto until they are scared shitless that they're about to lose it or lost it or heard someone lose it or, something like that. So.
Exactly. Yep. And I understand why that's the way that is, but it's just unfortunate.
Yeah, it is. But you can't, you can lead a horse to water, but you can't make him drink.
Yep.
So you can tell them that, hey, by the way, you need to learn this stuff. And I guess what are some common mistakes that you see people make? Like, is it mostly around taxes or budgeting, or is there I guess budgeting and debt and spending beyond your means are all kind of the same. But I'm wondering, like, how much is it like behavioral? How much is it lack of knowledge? How much is it is just carelessness?
So I would say the most widespread mistake, obviously, is discipline. It's budgeting. It's managing your money within your means.
Yeah,
now, obviously, that's we can move past that just because everyone knows that's the biggest problem right now in America, personal finance wise.
Right.
Aside from that, I think that the two biggest problems that I see are, like I mentioned before, they just don't know the implications of the decisions they're making tax wise. They don't know the opportunities available to them. They don't know that they might be making mistakes. And that's one subset. And then the other subset is almost the same side or the different side of the same coin. And that is that a lot of my more younger clients, Gen Z clients, are so excited to start investing because they've been watching TikToks or seeing people, Wall Street bets, whatever. It's really actually dangerous.
Yeah.
They're so excited to start out with it that it's almost like, we're in Colorado, so we like hiking. It's almost like you're so excited to hike the Colorado Trail that you just drive there and start running. And you didn't bring a water bottle. You didn't bring a compass. You didn't bring a map. You didn't bring a GPS. You didn't bring your phone.
Shoes.
It's like, dude,
food,
what are you doing?
Extra pair of socks.
And so I empathize with them with their excitement about it, but we have to slow down because getting back to what I was talking about before about having a plan, if you don't know where you're going, then how are you supposed to know what the next step you're going to take is? You have to start with the end in mind.
Well, how do you find the time? I mean, because I guess like many people probably say like the counterpoint, life is moving fast. I mean, just look in the last 6 months, AI, how fast it's grown. Like I made my profile picture with AI like 6 months ago and there's like 3 iterations newer. So like to the same point, like, I mean, I feel like things are going so fast. You almost don't even have time to sit down and make a plan. Or if you do make a plan, it's not going to go according to plan. So the Gen Z millennial method is like, well, screw it. Let's wing it, man. We'll make it up as we go. All right. So like, what do you say to that?
So I can understand why that's the mentality that a lot of people arrive at. I do believe that it's flawed. And the reason for that is that just because we don't know exactly what's going to happen in the future does not mean that we should not plan and should not take strategic steps to optimize our situation. So what I mean by that is that, we make a financial plan and in a month, in 3 months, in 6 months, maybe in a year at best, it's already broken.
Right.
Like you said, because everything changes. These Gen Z millennials, their lives are moving a million miles an hour. They're switching jobs every 6 to 18 months. They're having kids. They're buying cars. They're buying houses. They're getting married, all the things. So what can we actually do? I like to compare it to a hurricane projection. Not that my clients' finances are hurricanes, but when you watch the weather.
Before they get to you, they are.
Well.
After it's a nice, balmy, tropical day.
Come on. But no, so like when you watch the weather and when there's a hurricane or tornado coming in, what they tell you is that hurricane is going to hit anywhere from Fort Lauderdale to Charleston. And as it gets closer, it narrows down. That's the exact same thing we do with our finances.
The Monte Carlo projections.
Some of that.
But basically, like the closer you get to the present moment, the less variable the outcomes
exactly
are.
And so, for all of y'all that are watching and aren't familiar with Monte Carlo simulations, in a lot of ways, they're kind of the backbone of the financial planning industry right now, which I don't love.
Okay.
But it's basically taking into account a whole bunch of different factors of your current situation. So savings rates, assets, investment returns, other things. and then a whole bunch of different assumptions. And it's saying, you have a 93% chance of reaching the age of 95 and not having $0.
Not running out of money, right?
Which that's useful. But the thing is, all models are wrong. Some are useful. So
and
we
your
use
quality
that.
of life at having $5 or $0, like it's not taking into account what
Exactly.
the quality of life is like.
And they're just unrealistic, because the thing is that assumes that everything stays the same. But if your portfolio is going down, you're going to start spending less.
Right.
But it doesn't take into account for that.
It doesn't.
No.
It doesn't take into account any sort of reactionary behavior changes to this outcome.
Exactly. And so they're great for saying like, hey, you're doing great or excellent or bad or fair, or you really got to change some things. They're great for that.
They're useless.
But the thing is with our clients, like, like you said, like things change so fast. So we're more trying to focus on what matters and what we can control.
Which is the behavioral aspect. Because that, like,
Yes.
regardless of the environment, the economy, your behavioral traits and discipline, you can take that with you, right? Like,
Exactly.
I set a little bit aside to save because that's part of my behavioral, like, since I've got my first job in high school. Like, I've always paid myself first, right? And it doesn't matter what I earn, doesn't matter what I spend, doesn't matter what I'm doing to earn money. It's always that. And,
Right.
and that's, so those are the things like that you're helping people with, is like the behavioral aspect. Like when things go up, although as much as I'd love to say, I don't get sucked in at the top, you're supposed to buy less, right? And when things go down, you're supposed to buy more. And so, I mean, the behavioral coaching there too, like the emotional aspect, I imagine that's got to be the soft skills, because asset allocation,
a robot does it.
That's not going to cut it anymore.
Yeah.
Right?
So, I mean, we start out with that long-term plan, and we do use Monte Carlos to, say something to the effect of, hey, you should be saving this amount for it to be on track. But the thing is, that's going to change. It's already wrong, probably.
Yeah.
And so, while that's a great rule of thumb to go by, then we say, all right, you need to do this long-term. We know that's going to change. We're going to course correct along the way. In the present, though, and let's use an example in late 2020. In the present, though, you bought your house in 2017. Your mortgage is 4.5%. Right now, you could refinance for 2.75, invest the difference in your payment, have effectively the same cash flow each month, and then we could even do a cash out refinance and invest that money in your investment of choice, whether that's crypto, the stock market, your business, things like that. So right there, that decision alone, if they do that, we have like a whole big mathematical model we built out that unfortunately now we don't use because interest rates are higher.
Right.
But by doing that, we could say, in 30 years, assuming that the world doesn't blow up, your net worth is going to be $100,000 higher. And your cash flow each month did not change at all. Mm-hmm. Or things like, hey, you're running a business, you don't have any employees, you have a whole bunch of profit every year. Let's do an S Corp. Let's have you pay yourself $60,000 a year, which is a fair salary for your position.
Right.
And then let's save 15% in self-employment tax on all of the other profit up to $200,000. Right. That's $20,000 at least in savings.
Solo 401k or something.
You put that in whatever you want.
Whatever you want.
But the thing is, that's all we did was move some levers, and now they have $16,000, $20,000 more this year because they're paying less in taxes.
So the big, it sounds like it's like debt strategy and tax strategy and estate planning is really where the nuggets are found.
Yeah. There's the big long-term plan, and there's the qualitative behavior stuff. But then in the present, the thing that has them, keep on paying my fees, the ROI and what they're paying me,
that's what that
is the quantitative stuff. It's the tax strategy, debt optimization, risk management, estate planning, things like that.
How do you think about, you're talking about debt, like how do you think about debt? Were you raised as debt good, debt bad, or?
I was raised around Dave Ramsey. But I do believe that it's more nuanced.
Pay off your mortgage.
Yeah. I mean, the thing is, when you give advice to the masses like Dave, you have to be general. So it can only be so good. Oh. So he helps a lot of people. But the thing is, I disagree with a good amount of what he says.
Well, I mean, I view debt as a lever.
Mm-hmm. Yep.
And leverage can be good or bad, depending on how it's used and where.
It's just a tool.
Right. It's a tool.
Debt is a tool. Life insurance is a tool. Your investment portfolio is a tool.
Right.
And so to, villainize any one of those things is just as bad as in the fitness industry when they say carbs are the worst or fat is the worst.
Love carbs.
Or protein is the worst.
Love all of them.
Yeah, exactly. And so
a balanced diet, get
a diversified diet. Yes.
Yeah.
But no, I view it as a tool, and your behavior is what determines the outcome. So when you have great behavior and when you use debt in a way that produces, in a way that's economically effective, your progress will be accelerated. When you have bad behavior and when you use debt, whether it's, quote unquote, good debt or bad debt, it's probably not going to go that well because the behavior problem is the root of it.
I look at it usually as debt that's used for consumption, probably in like the most general sense, probably shouldn't be debt taken on. And then also the other type of debt that shouldn't be taken on is bad investments that grow at a rate of return less than the rate of debt. The unfortunate thing about that is not usually that's not foreseeable. You don't know that, but you do know if the money's for consumption or investment purpose. So my general guidance, like to my friends and stuff, because I don't give financial advice anymore, and thank goodness I don't, is just like, hey, like, don't get into credit card debt. Like, that's bad debt.
That's pretty much always bad.
In general, like, not only are the rates disadvantageous compared to like
any other type
of debt, yeah,
almost any other.
But then generally in the opposite, debt used to acquire an asset that appreciates in fiat currency, like a house, as an example. Although I think houses are overpriced, for better or for worse, they go up in fiat terms.
Right.
And typically, historically, that's why houses have become the number one biggest piece of people's net worth, right? Like most people's largest, I mean, maybe not your clients because like they're business owners or crypto investors or something, but like in general, like modern America, like they're almost all like if they own a home, that's probably the bulk of their net worth. So that is good debt in that way.
I do agree. I think that home ownership being the best investment you can make, or one of the best, is one of the most widespread myths in America today, personal finance wise, because homes are not the best investment ever.
No,
in fact, over the last 100 years, they appreciate like 3% ish. And that's not including the taxes you pay, not including all the expenses you're paying to own your home,
right?
All that stuff.
Yep.
And so really the reason why for many Americans, their home is their biggest asset is simply because it's one of the only things that they bought and held for 30 years. That's why.
So it's really the behavioral aspect.
Yes.
Yeah, I guess because if you had bought, the S&P 500 30 years ago, you probably would have done just as good, if not better. Right. Maybe the tax incentives though, with the mortgage deduction and but then like you also have the downside of that, which is like the property tax. I don't think you can own a house. I mean, you could
argue like you rent it from the government because if you don't pay your taxes, you lose it. You can make that argument.
That's the hill I'm dying on. You don't own anything.
I don't disagree.
If you have to pay a monthly or annual service cost, or if you have to pay a pittance to let you have it, you don't own it.
But to be fair, like that is the highest level of quote unquote ownership in society today. Now, I will say though, the statements that I'm making about home ownership, that is from a personal residence standpoint, because real estate can be a great investment. It can be because it's hyper localized. So if you buy good assets at great prices, buy them on cheap, that's great.
This neighborhood in Denver 5 years ago.
Exactly.
I mean, yes. Did the value of everything go up in fiat terms because of fiat monetary manipulation? Yes. Did it also go up because this neighborhood is booming compared to what it was 5 years ago? Maybe even more to more extent. Like this area was slums. This building didn't exist 5 years ago.
Yeah.
And now it's like a hot area in Denver, Rhino.
It is.
Rhino's like the spot. So
the tax benefits and the leverage you can have with real estate too. Those are the two factors that can make it really competitive investment.
Mm-hmm.
Because if you just buy real estate outright, $200,000 in cash for a $200,000 property, the stock market's probably going to beat you. Crypto's probably going to beat you, whatever. But the thing is, if you put $10,000 down on a $200,000 property,
20-to-1 leverage.
Exactly.
If it goes up 1%, you get 20%.
Exactly.
Right.
So if you're comfortable with the risk you're taking, if you can afford to make that payment, whether or not you have renters in it, then the thing is, at that point, that 3% return is immensely higher because of the leverage.
Is there some sort of like systemic risk that's just been building up for 50 years because everyone thinks their houses are valuable, and like like kind of what you were just saying is like, your house isn't actually going up that much. It's really the leverage that's making the return amplified because you're only putting down a fraction of what it is to cost to acquire. You can't get 50-1 leverage to buy stocks. You can't get 50-1. Only BitMEX will give you 50-1 leverage to buy that. Actually, I don't even think they'll give you that.
You got to have a Russian VPN.
Yeah.
But we're done with those days now.
Right.
So.
Yeah. 20 years in jail and $1 million fine. Thanks, IRS.
Yeah.
So if that's the case, then like, is there just like this big bubble that's just sitting out there where all these people are sitting on these like hyper like inflated assets of 50 years that like they don't even know any better because it's been for so long that like when the demonetization of homes comes, that's like one of my biggest, I want to buy a house for the use case, like because I know I need to use it. And you can't live in a Bitcoin for better or for worse. You can't do it.
No.
I've tried. Sorry, folks.
I mean, I feel like you're getting into a really philosophical concept here, which is money and value in general.
That's what I'm trying to get to.
So things are only worth what people think they are.
Right.
People think the dollar is worth something because it's backed by our F-16s. So
that's true.
In that sense, you know, if they say it's backed by nothing, well, it's not quite backed by nothing. It's backed by our military and other things.
Have you read Jason Lowery's book or heard of?
I don't think so.
Soft War. I'll tell you about it after, but he essentially says that like he works for the Department of Defense and he says that, you know, who owns property is settled by violence at the end of the day. Like if you don't agree, if you own this and I come in there with tanks and F-16s, guess who owns it now?
Yeah, I own this now.
I do.
We're going to liberate them and all their oil. Yeah.
Right. And but his argument is that like Bitcoin hash rate could be like this sort of meta war where it sort of takes the actual physical war out of it because the whole point is like you don't actually need to exert the dominance. You just have to show that you can to discourage it from happening. Yep. So he uses like antlers and he's like, you know, the antlers aren't meant to kill. They're meant to deter you from ever messing around in the first place. They can kill, right? So he gets into like, you know, this idea of, you know, can hash rate be used as like power projection without actually creating force, like without destroying it.
I mean, it seems entirely possible to me. I think, it seems possible. I think to get back to your original question, what assets are worth, what things are worth is just what people think they're worth. So I think that you could be right in saying that there's this huge systemic bubble where houses may not be worth what they're really worth and the dollar may not be worth what people really think it's worth, or other things may not be worth what people think they're worth. But at the same time, if everyone in the world thought that this glass of seltzer water that I'm holding was worth $100,000, is it worth $100,000? In my opinion, yes. Because I could go out and sell it for that today.
Right.
Now, is that value very fragile?
Yeah.
Yes.
Right.
I think that's my take on that.
Yeah. Okay. I guess I wonder how much of the value is, I think that homes have taken a lot of monetization because of the lack of the dollar's ability to hold value. Because dollars don't hold value, people naturally look for other ways to preserve their value in the best risk-adjusted way they can. And this is why bonds exist. This is why stocks exist. This is why homes exist. This is why commodities and speculation of commodities exist. So I just wonder, like, how much of the, you know, nominal value of the homes is like
propped up by the dollar
monetization of the asset rather than the use of the asset. You know, I would guess it's like 99% of it.
I don't know. But what I will say is that I agree with you, because if you look at what was happening in 2017, 18, 19, 20, 21, quantitative easing, the money supply increasing. Yeah, that was what happened.
Right.
You know, there were immensely more dollars flowing around, and therefore people used those dollars to buy other things because the dollars themselves weren't worth as much.
Right.
So real estate went up, crypto went up an insane amount, stocks went up, other things went up. Yeah.
What's an asset allocator to do these days? You know, I mean, like, stocks are way overvalued on a price to earnings historical basis. Bonds, I mean, they, you know, even treasuries have brought down, you know, some of the biggest banks, like don't buy 10-year treasuries or you'll literally collapse the economy, right? Obviously cryptos, Elizabeth Warren's running her whole campaign against crypto. Real estate is a bubble, what? Like, I mean, you already know what my answer is, but like, what do you do? Like, and what do your clients do? Like, do they do a little of each? Like, is that the best strategy? Like,
it all comes down to what they want to do. So right. Like I was saying earlier, with that concept of like shooting an arrow at a target, if you don't know what you're shooting at, you will hit nothing, no matter where the arrow lands. At the same time, though, being their advisor, it's about their target, not about mine. So it's about whatever they define as their bullseye. So when it comes to that big long-term plan that I was talking about us developing, which is the first stage, and that kind of answers everything else because we work backwards from that and where do we need to go? Plot your course. Well, figure out where you're going, then plot your course is what I'm getting at. They say, this is what I want to accomplish in life. This is what I want to do. This is the risk I'm comfortable with. This is the minimum situation that I'm comfortable with. This is the, my goal. And then that determines what they need to do. So for some of them, they come to me with 100% of their assets in crypto or effectively 100%, minus maybe their cars and their house. Mm-hmm. And they tell me that they're really concerned that if crypto goes down, they're going to lose everything and they're not going to be able to retire and other things. Or not
one Bitcoin is one Bitcoin, folks.
One Doge is also one Doge, though.
That's true. That's true.
Well, Doge is inflationary, though, and Bitcoin's not. But at that point, basically,
you're right. Bitcoin doesn't have...
Come on now, that's a good word.
This is actually inaccurate. It does have inflation. It doesn't have terminal inflation.
Yeah, I mean, like...
But one D is 1B is the real meta. Okay, yeah. We're going to move on. Sorry, go ahead. So they come to you with 100% of their assets in Dogecoin and say, I'm crazy.
Well, no matter what, if it's 100% in Dogecoin, I'm going to say, let's reconsider that.
Yeah.
Now, if it's 100% in, say,
appropriate.
Yeah, I also think so. If it's 100% in just crypto in general, let's say, a fairly diversified portfolio of digital assets, and they come to me with that, I'm going to tell them that, hey, based on the fact that you do want to retire early, let's say they're 30 years old, they want to retire by 40. I'll tell them, hey, look,
that's me.
I am regulated by the SEC, by the government. I'm required to tell you that this portion of your assets should be in traditional investments, the stock market, et cetera.
Okay.
Now, I did the math, and if crypto goes to zero, here is the amount that you actually would need to have in order to not have lost everything. And then basically, I tell them, hey, I actually really do think that you should diversify to that amount because if it does go to zero, you're toast. Now, they can take that advice or they can leave it. Mm-hmm. But then we go from there. Usually they do take that advice. And we go from, okay, so this is the minimum amount to have that bare minimum lifestyle if you want to retire early and, not have all of your risk riding on crypto.
Right.
But then we go from there and say, how much do you want to shoot for the moon? That's the minimum amount. That's what I'm recommending. Do you want to just full send it and that's YOLO. All you want to sell? Do you want to not sell anything? And I'm going to, tell you each time we meet, hey, just a reminder, you should consider
By
this.
the way, I have to do my responsible fiduciary duty and tell you not to be 100% long Dogecoin.
And then it's up to them. And when it comes to just portfolio management theory in general, I do personally believe that having a small amount of your portfolio, almost no matter who you are, not for everybody, but having a small amount of your portfolio in highly speculative, high risk, high reward assets, it's good portfolio management.
Absolutely. There was 3 buckets that I always looked at. There was my will not compromise bucket, which was bare needs, like food, shelter. This bucket has to be able to take care of this. Then there's the middle bucket for me, which was the things that I like to do. I would like to have a very nice house and a fancy bed. It doesn't have to be a fancy bed. But it would be nice if I could get one of those ones that has a sleep number that gets to exact that temperature. And then the lady next to me is oh, I wanted a different temperature. And I'm by all means. So
sounds nice.
Yeah. But then there's the aspirational bucket, which is I want those things, but while I'm on a Gulfstream jet.
Right. Exactly.
And that's there's levels to that,
Right. And that's what I'm getting at when I talk to people. I'm saying hey, this is, your bare minimum. And then how many more of these things that are past the bare minimum do you want to have riding on the success of crypto? And how many do you not want to?
Do you ever get into a bit of, I wouldn't say argument, but your clients are coming from crypto. Mm-hmm. And I would imagine like if you were to tell me, hey, Zach, like maybe you should like diversify into crypto, I'd be like, I know this asset and I absolutely understand. And as someone who used to be an advisor myself, appreciate the level of groundedness that you have and that you would recommend. But what do you say to those people who are like, no, I literally got rich from crypto, or like, this is my thing. Like, I get it. Yes. But like, if you understood the asset, you wouldn't say that. Like, I'm sure those conversations come up at least some point.
I mean, I'm also coming from crypto though. I've been in the space for almost a decade. I do understand it, not to the level that many of my clients do, because I understand more the planning, risk management, tax strategy, security, holding, all of that. Whereas they understand the day-to-day of the projects they're working on, other things. But that said, I just, I tell them that ultimately it is up to them. But my role is to be that grounded advisor.
Right.
My role is to be that third party who's telling them, hey, this is what's mathematically worked. And I don't have a reason to believe that these mathematical principles are going to change. So that's what I tell them. And then I'll just remind them of the risks that they're taking. And some of them are like, shoot, I didn't think about that. And some of them are like, yeah, I'm aware that this is the risk I'm taking and I'm comfortable with it. Because if crypto goes to zero, if it all fails, if Social Security is still around and that's all I have to live on, then it was a great experiment. I had a good run. And then some of them are like, you know what, actually, I do want to full send it, but also I want to lock in my kids' college. I don't want to play with that. Things like that.
Right. Like some more concrete goals. Yeah, I guess like, I mean, do you have like or most of your clients, like, do they have families yet? Or they're kind of like starting families?
So
maybe no commonality.
It really depends. But so the reason I knew all those percentages earlier is because last week I was looking at my practice and breaking it down.
Right.
So I want to say it's like right about 50% or slightly under have kids. Yeah. So not all of them.
That seems high. So like over-representative of the population, because like 50% of millennials don't have kids, like not even close.
Yeah. But I guess if you think about it,
less than half that, maybe like 15%, dude, it's like nobody has kids in the US.
Yeah. No, I don't think you're wrong. Average age of 30 and a half. And if half of them have kids.
Yeah, I guess the 30 is a little
I think
older.
You might still be overrepresented at 30. I don't know about the US's numbers. I just know my practice. But if you think about it, who are the type of people who are at the point in life where the pain is great enough that they want to hire an advisor and pay someone to help.
Things get complicated.
They have kids. They're like, shoot, I can't wing it anymore.
When you start your own business and then have kids, you complicate your tax structure like by like tenfold. And then like you add crypto into the mix, maybe you got some retirement accounts. It's like, things get a lot quicker, a lot hairier really quickly. And then you're married, so you have like different brackets, but then you're doing both your taxes, so it's like, I can see that.
So I mean, it's not really representative of the US population.
Right. How do you think about retirement accounts? Because I still have my Roth.
Oh, you do?
Yeah.
Oh, that's right. I thought you said you sold everything. I guess the Roth was the only thing left, right?
Yeah, because I had already paid the taxes on it. And I was like, if I take it out of the Roth, now I just have to pay the taxes on it. So that's kind of freaking stupid. If it was a traditional, I would have withdrawn it because like pre-tax money anyway. Like, I want the one in the hand is better than two in the bush, And that's how I feel about retirement accounts today. Retirement accounts are custodial accounts. As you've seen, custodians don't have what they say they have. And so I don't want to have any value trapped in custodians. I'm saying this on the record, I'm probably going to regret not cashing out my Roth because there's no taxes to do it. It's just like, it's you get your basis back. Like, so you can take out your basis in a Roth.
Yeah, I mean, there's a penalty.
No, not even for your basis. Just
not for your basis. Yeah, no.
I bought Bitcoin miners. There are no gains anymore. Trust me.
Oh, well then, you can take it out. No penalty.
But like if it 100x's, it's capital gains, and it's like, it would have been smart to take it out. Like now, it's like less than my basis. So like,
right.
I literally paid taxes on money that I didn't even have that I couldn't even take a tax deduction on. So anyway, point being, I'm still like, I'm kicking myself for putting as much in a retirement account as I did when I was younger, particularly in a Roth, because it's kind of like that. It's like tail wagging the dog sort of syndrome that I feel oftentimes. But how do you talk to I mean, you're talking about like Social Security and like Medicare. Like, I don't think those
Social Security.
Okay. All right,
to be fair though, so
I don't think that'll be existent in 10 years.
Do think that Social Security will exist. And
Let's
part of the reason for that, I don't know if I'm going to bet on it, but the thing, and I don't bet on it with my clients. I say if it exists, it's going to be extra. It's not going to be that much extra considering what they want to have in retirement. But anyway, if you look at Greece, their entire financial system collapsed. They were toast.
Right.
And their social security system still pays out. And so when you look at
the
that,
euro hasn't collapsed yet.
Right. So there's more going on there than just the simple statement I just made. But that said, people make these big statements like Social Security is going bankrupt in the next 10 years, or, it won't be around. We got to get rid of it. And I don't see in our current system a politician getting up there and saying, hey there, 40% of the voter base. Hey there, 50% of the voter base. We're taking away your checks every month. Vote for me.
I don't think I
don't see that happening.
I don't think anyone's going to like willingly do it. I just think that how I think it's going to play out is the money's going to collapse. And they're going to be like, well, we got a bunch of worthless shit in Social Security. It's called dollars and it's worthless, just like all of everything. But, I'm optimistic, and I still am optimistic that, the U.S. government is literally market selling thousands of Bitcoin. They're so stupid, but I'm optimistic that they'll figure it out eventually. And, I don't think the end of society or even the end of our economic system or social system in some ways today will be because of Bitcoin. But I think there will be some major changes, and one of them being like the entitlement programs that are based on debt. If the debt is not, it just can't go on in perpetuity. So I don't know if it's either going to be extended. It can go on longer.
Right.
It just can't go on in perpetuity. And I'm like, well, why even do something if it's not sustainable forever? Which I guess, that I think is something that you could argue against. Nothing is forever. Why make your bed? Because you're going to fucking make it dirty tonight.
Right.
So why make it? So why do anything that's not, in 50,000 years in perpetuity, sustainable? I don't know the answer to that. But.
Yeah. I think the only other thing I would say is that a lot of the other argument for Social Security people base it off of is that it's going to run out of money, when, as far as my research indicates, in 10 years or so, it's projected to start at a deficit.
Well, it's not going to run out of money, right?
But
because they can just create the money.
Exactly. And the other thing is, what government program do you know that isn't running at a deficit?
Right. Because they can just create the money.
Yeah. And I agree with the fundamental problem with the money here.
Right.
Yeah.
And that's kind of where I want to bring the conversation to, because I think that part of the reason I left personal finance was because I came to the conclusion that the problem is the money. And so I just felt kind of foolish trying to solve a problem in a system that was broken from the get-go. It was well, if I measure how good of an investor I am by how many dollars I retain and grow, but that number itself is a skewed data metric, then I have no way to even measure my progress, or my ruler of how I measure my progress has been corrupted. And therefore, I'm not it just got to the point where it was I couldn't do it anymore. And so I'm curious how you think Bitcoin's going to change the world of personal finance, and if you think it'll be kind of everybody overnight better learn this thing, or if it's it's slow and steady. It'll be people like you and kind of the old guard coming, falling off. And
I'm not sure. What I will say is that I feel in many areas of the world today, whether it's crypto, monetary policy, Bitcoin, politics, it would be so convenient if the future and the present were black and white and it was just one or the other.
Yeah.
But the thing is, that's just not how the world works, and that's not going to happen. And so, I can understand where no coiners are coming from, saying this is stupid, it's play money, it's whatever.
Yeah.
What about the US dollar?
Right. It's all money.
And then on the other side, it's people saying, the banks are going to fall, the institutions are going to fall, the governments are going to fall, everything's going to be ruled by Bitcoin. It's going to be our turn to be the ultra rich and whatever.
Right.
I just don't see that happening.
There's
either.
some ego in there too.
And so I don't know where it's going to be, but I think it's going to be somewhere in the middle. And I could see, obviously, I don't know what's going to happen, but no crystal ball here. But I could see a world where there are still government currencies. There are still maybe the US dollar, maybe an electronic US dollar, whatever. And unfortunately, yes, I think those would be centralized, just like the US dollar, the electronic proposal for it seems to be basically just completely centralized. No decentralization, no transparency, whatever.
Which, like,
to be fair, what did you expect?
Right.
And I think that it's possible that those could exist alongside Bitcoin because they can't ban Bitcoin.
They can't.
It's too big. They can't stop you from using it.
And they're not going to encourage it either because the government's not going to just give up willfully its control over the money, just like they didn't willfully give up control over the church.
Right.
I mean, there was literally a whole country formed called the United States. Like that was like one of its founding principles. It's like, I mean, that and like taxation of tea. Like,
yeah. I mean, I don't want my tea taxed. How dare I pay 2% on it? I'll pay 50% of my income.
If the founding fathers got taxed for half the shit that we get taxed on today, dude, this whole country would be up in flames, man. Like there is a certain level of satisfaction or just whatever. Well, I'm blanking on the word. I wish I had better vocabulary. Apathy. Yes, thank you. There's a certain level of apathy that I feel like our population has. And it goes back to what we were saying earlier about like people don't take change until they feel pain.
Yep.
And I think there's a lot of pain coming.
There's a lot of pain.
Financially.
I will say though, the US dollar, aside from Bitcoin, in my opinion, is still the best currency we have available.
Oh yeah, it's the best of the worst, dude.
Like it's super flawed. It's the worst, but also it is the best we have available aside from Bitcoin, aside from crypto.
But the thing about currencies is that like they are kind of like a winner take all. I viewed them as. Now there are other factors that are at play, like force. You can force someone to use a currency, which is a valid rebuttal. But given a free market, a rational actor will choose to store all of their value in the best currency and none of their value in the second best. So while I do agree that centralized CBDCs are probably going to coexist alongside Bitcoin, I don't think that you will want to store about your value in them other than two reasons: ignorance or force.
Or apathy. Yeah, which I guess is partially ignorance.
The ignorance, yeah.
But the thing is, like,
the ignorance.
Yeah.
Like you wouldn't know any better.
I mean, I would also argue, though, that most people in the United States today that have investments that have, a bit of a net worth built up, they aren't storing their assets in the dollar. They're measuring their assets in the dollar, but they're not storing it in the dollar.
And that's the problem. So, they measure their assets. Imagine if, and you know this, but I'm just kind of repeating it. Like, imagine if, like, we were trying to see who was taller, right? And like you were using a different, like your ruler said a ruler was 13 inches, right? And mine says it's 14. Neither of those are actually what a foot is, but who knows? Because the ruler, what a foot is changes over time.
Right.
So like there is no measurement of like, well, you got to give me more information than that. A ruler, like you were 6 foot tall on what day? Because
was it raining?
Yeah. Like, was it raining? Because that affects the, how wood compresses. Yeah. So like, and I feel like, and that's where I got kind of dejected about the personal finance aspect, because I realized that I was kind of trying to give people advice and like spinning my wheels. And again, this is like my own personal, like what I felt like. I just was like, I don't know that I'm actually giving people, like I thought that I was. But once I realized that the way that I was measuring the effectiveness of the advice was sort of broken in and of itself, I just couldn't do it anymore. And that's why I'm so adamant about Bitcoin. It's like, hey, yes, Bitcoin is a shared delusion. It's a made up money, just like fiat. And I will be the first person to admit, Bitcoin is made up. All money is faith-based. It's all based on sentiment.
Yeah.
What other people are willing to pay for it. The difference of Bitcoin is that the rules don't change. And the way that it's been set up pretty much ensures that the greediness of individuals will make sure that the rules never do change until they absolutely have to. And that is the one difference between fiat is like, it changes when they decide they feel like it.
Yep. They can change the rules. They move the goalposts.
For special interest groups.
For special interest groups and for themselves. I think that with I understand where you're coming from, and I understand why you exited advice because of that. Personally, I think that I don't feel the same way in the sense of, you said that it could go on longer. I do think it'll go on longer. When we're talking about going longer, I'm talking about the banks, money, all that. I think that it is fairly sustainable. Yeah. I mean, these words might age like milk, but I think that it's fairly sustainable.
2 weeks from now, shit all comes crashing down before we even post it.
Yeah.
Sustainable.
Just like for the next many decades, I think that it is. I think that I agree that it just can't go on forever, but I think it can go on for a lot longer than a lot of Bitcoiners would say. Obviously, they're going to disagree with me, and I'm okay with that. That's fine. Yeah. And then the other thing is that I hold that perspective myself, but like I said before, it's about the client's target, not mine.
Right.
And so, I think that the tax advantages of 401ks, IRAs, and other things are great. If the client refuses to put things in there, we'll figure out other ways to make the best decisions possible in their situation. The other thing also is that many people don't realize you can effectively self-custody your 401k funds or your IRA funds through a self-directed 401k or IRA. Right. And so if you're worried about the government taking your money or Charles Schwab, that's probably, I mean, this isn't financial advice because you're not a client, but probably.
Here, let me give you $1.
It's more than $1.
Shit.
But
one Bitcoin.
What most people should do if they refuse to put it in, what I understand why, in managed custodian held IRAs and other things, the tax benefits when you have a significant amount of funds to put in those accounts are so significant that even though it is complex and even though there's accounting fees and other things to self-custody effectively your own retirement account funds or qualified funds, it's usually worth it. Because if you have a couple $100,000 or more, or if you're contributing the maximum amount to your solo 401k each year,
it's
which
like
if you're
50-something thousand.
No, if you're a solo business owner, you can get, I think, up to $64,500.
That was a couple of years ago. Yeah. The limits have changed.
So for my clients,
shows you how long it's been.
if one spouse is the owner of the business and they employ the other spouse for a reasonable salary, reasonable comp, you can get $128,000, $129,000
as of 2023.
As of 2023 into a tax advantage location.
Right.
Which the current year deduction of that, taxes that you aren't paying this year, that you almost definitely have to pay later, but you're not paying them this year. That's almost $40,000 saved right there. And then you can use that money, you can self-direct it, and you can hold crypto in there. Right. You can hold Bitcoins in there. You can hold real estate in there. I guess you don't have to hold your Tesla stock at Charles Schwab.
I mean, that sounds like too good to be true almost, because it's like you get the tax advantage of the retirement account structure, and then assuming everything doesn't blow up and go to shit, you get the tax savings. And if it does go to shit, I mean, I've got the Bitcoin on my private keys. So
exactly.
Like, what do you?
A lot of Bitcoiners appreciate that.
I withdrew it. 10% penalty. Come and get it.
And that's the thing. So like that's where I think a lot of Bitcoiners find value. Yeah. Because there's still ways we can meet in the middle. You don't have to be, in mutual funds at Charles Schwab to take advantage of that
stuff. Or Grayscale fund, it's been. I mean, I'm back.
Imagine paying 2% a year to hold Bitcoin.
I have been.
No.
Yeah, because got so destroyed by the discount widening that now I'm like holding it till it closes, and then I'm going to get rid of it. But it'll wind up closing and I'll never get my money back. So anyway, next topic.
We'll see.
Besides not holding Grayscale for multiple years, what are some like pretty like straightforward? Do you have any like tried and true ways? And we're going to kind of wrap up here. Like tried and true ways of improving one's personal financial position. Let's say like someone listens to the podcast and they're like, you know what, Zach and Zechariah got it right. These guys made some sense, and I want to start making some action and taking some change, or taking action, making change. What are some like easy ways to start doing this aside from budgeting? I'm going to start with budgeting.
Right. Aside from budgeting,
don't spend more than you make.
Yeah, don't spend more than you make. I think the obvious number one is you have to be disciplined. You have to take matters into your own hands. You are the only person in the world that's invested in your success. You're the person in the world that's most invested in your success. No one else is going to work as hard for your success as you.
Right.
And so you have to wake up. You have to take action. That's my number one. And we're talking about spending less than you earn here and a couple other things. Number two, there are some huge benefits to simply having a plan and having a written display of that plan somewhere.
Yeah.
So you know what you're shooting for. And then every day, you know, like for example, I have my goals written on my wall and then in my office so that every day when I wake up, I see what I'm working towards. I have some scripture there. That's why I'm working towards it.
Kind of visualize it.
And then I have the same thing in my office. It's like, hey, this is what you're working towards. This is the prize. This is why you're doing this. So simply having a plan, thinking about what you're doing, that plan can be more detailed as time goes on, but just having something. And this is so simple, but so few people do it. It's so valuable.
And does this plan need to be quantitative or can it be more qualitative too?
I mean, I think you have to get to a point eventually where it's quantitative, but simply qualitatively thinking about where you want to be in life. What do you want to accomplish? You have to think about that stuff or else you're not going to take action. You're not going to do it. And you're going to wake up unsatisfied with your life in 5, 10, 20, 30 years. And you'll be like, what happened?
I've listened to some YouTube videos about people saying that you should like literally like visualize. Like what is it like sitting on the beach or, you know, smelling the ocean, you know, as you drive by in your Ferrari, like, but they say like, get as visual, you know, with it as possible, as visceral so that, because the more senses you tie to it, the more real it becomes. And you're almost kind of like manifesting it because, you know, and there's a whole, this ain't one of them podcasts, but like, I do believe in that stuff. And I told myself that when I learned about Bitcoin that I knew it wasn't like, I think Bitcoin is going to succeed. And so like, I should probably do something. It was like, nope, this is truth. This is like 96. This is, I'm just as certain that Bitcoin will succeed as I will wake up tomorrow. Actually, I'm more certain that because I truly am. I'm more certain that Bitcoin will succeed. Maybe not in my lifetime, but in perpetuity. Then because eventually, like I won't wake up, right? So, I think that's why it's also so important to like when you figure that out. For you, it seems like it's financial planning. For me, it's Bitcoin. When you figure you got to do it, you got to do it. You got to not even think twice about doing it. You got to cannonball the hell in.
Yep.
Because your life is short and your time is valuable. And when you really love to talk or do something, like that's what you should be doing because your work is going to be superior because you care about it, but it's also going to be more enjoyable because you care about it too, right? So,
And I mean, like you said, you know, this isn't one of them podcasts, and I'm not one of those people who, you know, posts on those like kind of cringy wealth pages on Instagram or whatever. But the thing about what we just said, you know, number 2, half of it is kind of buzzwords, kind of, you know, be motivated, have a plan. And some of those things, it's like 50% BS, but also 50% it actually works. And it actually is true, even though it is kind of cheesy. Yeah, I agree with you.
You have to have a plan and then be ready to abandon it.
Yeah, I mean, you got to adapt. If you don't adapt, you're going to die.
But you have to have one so that you know if things are going according to plan or not.
Exactly. Like I was saying, the salesperson I met with, if you don't have a quota, how do you know if you succeeded?
Right. You don't have to follow the map, but you need to have one so that you know if you are off track. And I think that's a pretty so reasonable. That's very broad. Yeah.
But the thing with personal finance is that it's just that it's personal. So I'd love to tell you what the next 100x is or what the sure thing is, but that's about as good as I can get without giving generalized advice that is going to be bad for some people and good for others.
The whole industry has shifted from, hey, this stock's going to go up to, hey, let me help you design a plan to fit the life, to build the life that you want to live, right? Yep. And it, like, as much as I'm not like really super keen on personal finance anymore, I think there's an absolute place for that in life, and in a Bitcoin economy, there's still gonna be.
Yep.
So where can I mean, dude, it's been a great discussion. I enjoyed it, and where if someone's interested in getting a consultation, or they really like what we were saying, and maybe they want to work with you, where can they find out more about your firm, and how can they get in contact?
Yeah, the best place to reach me is LinkedIn. So if you just search my name, Zechariah Schaefer. And then aside from that, my website is a great place to reach out to. And I think that...
What's the website?
The website is Ascent, personalfinance.com. So ascend like a mountain, trending upwards. Just that's because of who I built my whole firm around.
Right.
And then at the bottom of the website, there's an application to become a client. And just due to increased demand, due to the work that it is to evaluate clients, that's really the only way that we're accepting inquiries right now.
And typically, so you have any requirements, age, career, net worth, any of those?
Gen Z and millennials, tech professionals, crypto investors, business owners, at least one, ideally all three.
Cool. Any last words of wisdom that you would just like to leave the listeners with?
We've been talking about this whole time, but you got to start with the end in mind, because if you don't know what you're shooting for, you're going to hit nothing.
Right. I'm shooting for one Bitcoin is one Bitcoin. The world will be using it as a medium of exchange while I'm still here.
Hey, we might get there. I think it's entirely possible.
Well, it ain't going to be because of just me single-handedly. It's going to be every single person, contributing in their own way. And, I don't know how, I know we're going to get there. I'm damn certain, but I have no clue how or how long or how bumpy or smooth the ride is going to be. But I'm hoping it's soon, smooth, and easy. So.
Hey, that would be nice. Under budget and ahead of schedule is how we like things. Right. So
if all the financial plans turned out like that'd be
if only they did.
That'd be a wonder, man.
Yeah.
Well, thanks for coming on, brother.
Hey, thank you.